Today I would like to share more about computing GDP. So about computing GDP, which is like in last episode I mentioned, like we can use income method and expenditure method to measure the GDP. So in this episode, I think we can explain why both income method and expenditure method is suitable for computing GDP. So let us first focus on the figure 2.1, which is I would say the circular flow method. So we can see that if a household want to buy, for example, like what they assume it is the bread. So like if households want to consume bread from firms, so they must pay. So they pay, like they use expenditure to pay to firms. So firms transfer goods to households. So it is the same logic because firms' income can return to households. But you may say, sir, like firms' income doesn't like belongs to one household because like they would have income taxes and the firms need to have some revenue tax, and you cannot ensure the households like belongs to their firms or work for their firms. It is basically correct. But what we need to assume or know is that the money in a whole economy system is constant if like no more money is being supplied. So like eventually, although like you may say through government would use like government spending to make these like benefits like regained by the household. And also for firms, they will give wages to each like worker. So actually all the expenditure equals to all the income. And this to a large extent explain this problem, which is called the circular flow, which shows that an economy produces one goods, bread for example, from one input labor. So the inner loop represents the flow of labor and bread. So households sell their labor to firm, which we can say sell their labor. And also like households pay the firms for the bread, so the firms pay wages and profit to the households. So GDP is both measuring the expenditure and income. But what we need to differentiate is that we do not need to record both income and also both expenditure, because we can see it is the same thing, so we only need to measure one kind of like things. And despite the income, the circular flow diagram, we need to also focus on like what the inner loop and outer loop like represent. For the outer loop, it is like represents the flow of dollars, because households buy bread from the firms. If you want to like make it more clearly, it is like we just measure the unit in dollars. So like the remainder is the profit. It belongs to the owner of the firms, which is expenditure on bread flows from households to firms, and income in the form of wages and profit flows from firms to household, which is just what I've previously mentioned. And also GDP measures the flow of dollar in this economy. So previously I was pretty like do not understand about like what does this mean, but it is because the unit is measured in dollar, so it means like it shows how the dollar flow. And there I remember a famous economist used like flow of water to explain the reason why the whole total money in the whole society remains the same. And if you want, you can search for that model. And so two ways of computing GDP must be equal according to the rule and also according to accounting, because the expenditure always equal to the income. And there are also like problems about inventory, which I will like explain just later in this video. So every transaction affects income and must affect expenditure. So every transaction shows the profit what a firm produces and sells. So if a firm produces one more item of goods, so it means it needs to sell one more item of goods. Or if it become inventory, which means later like this kind of like goods have not been sold, it is recorded at the lower of its net book value or its cost, which is we called net realizable value. So we record at the lower of these two data. So clearly this transactions raises if I produce one more item, although it might not be sold. It also increase the expenditure and increase the income. So this is what this page wants to explain. Now we move on to the second page. This page might explain the stocks and flows, which is just like what is shown. Many economic variables measure a quantity of something, a quantity of money, a quantity of goods, and so on. So in order to distinguish between these two types of quantity variables, stocks and flows. A stock is a quantity measured at a given point in time, whereas a flow is a quantity measured per unit of time. So what does it mean? It has given a really vivid example. So this is a bathtub. So shown in figure is the classic example used to illustrate stock and flows. The amount of water in the tub is a stock. It is the quantity of water in the tub at a given point in time. However, the amount of water coming out of the faucet is a flow, which is the quantity of water being added to the tub, per unit time. So we measure stocks and flows in different units. We say it contains 50 gallons of water, while we say the water coming out is the rate of 5 gallons per minute. So it is kind of like a displacement and a velocity. So GDP is the most important flow, but not stock. So flow because it used to tell us how many dollars are flowing around the economy's circular flow per unit of time. So if we use GDP, it means the circular flow per unit of time, it is year. So if the GDP is $14 trillion, it means there is $14 trillion per year. So equivalently, we can see that there is almost $500,000 per second for US economy. So stocks and flows are related. So because the stock of water in the tub represent the accumulation of the flow out of the rate of flowing out, and the flow of water represent the change in the stock. So there are some examples. So a person's wealth is stock and his income and expenditure are flows. The number of unemployed people is a stock, while the number of people losing their job is a flow. The amount of capital in the economy is a stock, the amount of investment is a flow. The government debt is a stock, the government budget deficit is a flow. So what we mean this, if I can set up a model for you, in accounting, it means if you have a capital, then the profit for the year and loss of the year will be stock. So I do not know if you guys can understand. It means stock is kind of like a base, while flow, whether measured in of time year or of time month, second, hour, it is something that can be added to the base. So it means kind of that. If you have a number, then the flow is something that you minus or add. So something new is for government budget deficit would add to the total government debt. And yes, even they have a lot of that, they do not care that much. So it do means that, for example, my capital is 10,000. So if I had made a profit for this year, for example, 5,000, then my capital would be 15,000. So the 15,000 will be the new capital. And if a loss of 5,000 will be made, then my capital will again be 10,000. So, for example, flow is measured in year. So stock plus this year's flow would made the next year's stock. Then next year's flow and next year's stock will make another year's stock. So this is kind of things. And this is easy to understand. But we do need to know what GDP indicate and what GDP after measuring it, what does it shows. It is just a flow, but we are measuring we still get to know some idea about stock. So there are some rules for computing GDP. If we assume an economy only produces bread, so we can compute GDP by adding up the total expenditure on bread. Real economy, however, include the production and sale of a vast amount of goods and service. To compute GDP for such complex economy, it will help us to have a more precise definition, which is the definition I will be given below. And you need to remember it because we need to remember rules to avoid neither overstating nor understating the whole economy's value, whole economy GDP's value. Okay, now we look at what methods or what things we need to focus on. So we need to first give the definition of GDP, which is the market value of all final goods and services produced within an economy in a given period of number. So some work in progress, is that counted in the GDP? No. Absolutely no. Work in progress is not being counted in GDP according to this definition because it is all final goods and services. So to see how definition is applied, discuss about some rules. For example, adding apples and oranges. This example is quite easy. So GDP equals to price of apples multiplied by quantity of apples being sold plus price of oranges multiplied by quantity of oranges not being sold, sorry. So it is just quantity of apples. So GDP equals to the total value of both apples and oranges, which is $5. So what about some used goods? For example, a company makes a package of baseball cards and sells it for 50 cents. That 50 cents is added to the nation's GDP. But what about when collectors sell a rare Mickey Mantle card? I don't know what it is. I think it's a rare card for $500. But what we knew is that these $500 are not part of GDP because GDP measures the value of currently produced goods and services. The sale of this card reflects the transfer of an asset. So this is the case. This is the most important case in the whole GDP. So if these people do not do anything that add this value, so we assume that those 50 cents for producing one card has already included the probability to have a rare card. So what it means is that the value of good being produced is 50 cents per card. So if the card is even worth $5 million, it does not count because it was have already included. And this $5 million is just being negotiated, what the market price or price of this second-hand card is, or how rare this card is. So these two factors made how much this card worth. For example, so why this is not being counted? Because for example, for a single card worth 50 cents, it was the same value as for me for 50 cents one card. But if you say a rare card of baseball card for worth $500, as for me, people a person that do not like baseball, it just was the same value as a normal card, which is 50 cents. So these $500 do not belong to its added value. So it was not included as part of GDP. Only value being added is a part of GDP. For example, if I have a tissue, a lot of tissues, and I need to make them into packages, then the cost of raw material of these packages is being counted as part of GDP, or the selling price of this is counted as part of GDP. But if you say that, for example, I have a signed basketball of which player, then in this case, this basketball cannot be counted as an added value. We only count we say the cost of the ink of writing the signature, which is we can basically do not basically omit it. So this is the case. And the second is something about treatment of inventories, because inventories is especially important. Because just like what previously mentioned, quantity of apples, I do not say quantity of apples being sold. It is because we have treatment for inventories. So we cannot ensure that if a bakery produce more bread, so how, if they fail to sell the additional bread, how this transaction would affect the total GDP? So the answer depends on what happens to the unsold bread. First, suppose that the bread spoils. So in this case, the firm has paid more wages but do not receive any additional revenue. So the firm's profit is reduced. So wage has increased. So total expenditure in economy hasn't changed because no one buys the bread. Total income hasn't changed either, although more is distributed as wages and less profit. So it means just like in income statement, when we calculate profit for the year, in accounting, we need to deduct the wages. So if wages increase, but we do not get more revenue, which is in the gross profit column, then we need to make less profit, because if revenue is the same, more wages means less profit. So it is the same case. So less profit is being transferred and more is being wages. So the transaction affects neither expenditure nor income. So it does not alter GDP, because the transaction do not increase revenue. And this is the main case. Even if you increase wages, but what we say is profit decrease, tax on profit decrease, government spending, because government revenue decrease, government spending decrease, welfare being enjoyed decrease, causing if we measure it on monetary sense, also the total remain the same, although you receive more wages. So in this case, it does not alter GDP. We need to notice if inventory is being treated in this way. Okay, we talk about the next treatment of inventory. So suppose that the bread put into inventory is to be sold later. In this case, the transaction is treated differently. The owner of the firm must assume to have purchased the bread for the firm's inventory, which is for some clothing inventory. If we consider about accounting point of view, it will be the opening inventory next year. So though the clothing inventory, there has clothing inventory, but it will be sold later. So assume that the firm purchased the bread for the firm's inventory, so the firm's profit is reduced by the additional wage it has paid, because higher wages raise total income and greater spending on inventory raise total expenditure. The economy's GDP rises. So if one inventory is being abandoned, then neither expenditure nor income would increase. But however, if both the wage and also both the expenditure and the income rise, in this situation, it means the inventory is treated differently. The inventory can be saved into the next financial year to ensure this kind of inventory can be sold. So in this financial year, we just assume that the manager, sees just purchase all the clothing inventory. So what happens later to the firm, if they sell the bread out of their inventory? So it is a sale of a used good. So they're spending by bread consumers. So their inventory is disinvestment by the firms. So this negative spending by the firm offsets the positive spending by expenditure, which is from consumers. So sale of inventory does not affect GDP, which is something, because if we use the double entry system, the margin principle in accounting, since it affects last financial year's GDP, it will not affect this financial year's GDP. It is margin principle. We assume in this financial year, 12 months output belongs to this year's GDP. Then next year, it will be, just some GDP related to the previous financial year. So general rule is that when the firm increases the inventory of goods, this investment in inventory is counted as expenditure by the firm owners. Thus, production for inventory increases GDP as much as production for final sale. A sale of inventory, however, is a combination of positive spending and negative spending. So it does not influence GDP. So what influences GDP is the production, but not the selling process. So this treatment of inventories ensure GDP reflects the economy's current production of goods and services. And this is our two different treatments of inventory. And this is the end of video. Thank you all for supporting. Have a nice day.